Hey everyone, welcome to This Explainer. Today we're diving headfirst into the intense, honestly kind of wild debate surrounding Quantum Computing Inc., ticker symbol QUBT. If you follow the cutting edge of tech investing, I guarantee you've seen this ticker flashing across your screens lately. We're seeing incredibly polarized opinions here, literally ranging from deep value skeptics crying bubble to venture capital types screaming hypergrowth. Our goal today? Strip away all that emotion, look directly at the hard data from our sources, and figure out what's actually going on behind the scenes. Okay, so let's tackle the elephant in the room. Could QUBT really hit $50 a share by 2026? This is the burning question, completely fueled by analysts online anticipating just explosive, massive gains over the next couple of years. Across financial media and social platforms, there's this really vocal contingent arguing that QUBT is right on the precipice of a monumental breakout. They're painting this picture of a stock that's going to multiply in value rapidly. But to understand if that $50 target is actually realistic or just a total pipe dream, we've got to look at the numbers grounding this company in reality right now. Now, here is where things get truly staggering. $2.78 billion. That is the current market cap attached to a company that, wait for it, makes less than $5 million in annual revenue. Let that sink in for a second. The market has priced QUBT at nearly $3 billion based almost entirely on the promise of tomorrow, rather than the actual cash flow of today. That's a massive, massive disconnect between their current commercial footprint and their valuation. And honestly, that right there is exactly why this stock is generating such fierce, passionate debate. But before we weigh these extreme financial arguments, let's step back. What exactly is QUBT? Let's talk about their transition to becoming a photonic foundry. So the crucial thing to understand is their lab-to-fab model, which relies heavily on something called thin-film lithium niobate, or TFLN. Why does this matter? Well, it solves the massive, incredibly expensive cooling problem that traditional quantum computers have. Historically, quantum computers literally need near absolute zero temperatures to even function. We're talking huge, energy-guzzling refrigeration systems. But QUBT? They're using photonics, essentially computing with light, using this TFLN material to build machines that can operate at normal, everyday room temperature. If they can actually scale this, it's an absolute game changer. And their targeted product lineup brilliantly illustrates this goal. They want to bring quantum tech out of the dusty research lab into real, tangible, commercial applications. Think advanced cybersecurity and AI. They aren't just sitting around doing abstract math. They're aiming to be a literal foundry that physically manufactures these specialized chips. And with recent acquisitions, like grabbing Luminar Semiconductor, they're positioning themselves to provide standard hardware that can slot right into our modern tech infrastructure. All right, let's shift gears and look through the highly optimistic lens. Here is the bull case, pitching the quantum future. Proponents of the bull case point to one massive number, $150 billion. They argue that the total addressable market for quantum computing could exceed $150 billion over the next 10 to 20 years. The tailwinds here are undeniable, folks. We're talking about totally revolutionizing drug discovery, logistics, and hybrid AI computing. Plus, the US government is heavily incentivizing this space, literally treating it as a matter of national security. The bulls argue that if QUBT captures even a tiny fraction of this future market, then today's valuation is entirely justified. And when you look at their revenue growth, you start to see why people are getting so hyped. We're looking at an explosive relative percentage jump here, fueled by those recent acquisitions. I mean, going from $39,000 to over $3.6 million in a single quarter, year over year, that is massive percentage growth. Now, sure, the absolute numbers are still microscopic compared to their $3 billion valuation, but for speculators, this momentum is the ultimate proof of concept. It signals an inflection point, suggesting QUBT is finally evolving from a purely theoretical research lab into a real revenue-generating business. But to actually achieve that sky-high valuation by 2026, a few key catalysts absolutely have to happen. It assumes flawless commercial execution and massive government backing. The dominoes have to fall perfectly. They need those photonic AI cards to become the industry standard. They need to land highly lucrative government contracts to validate their tech. And, perhaps most importantly, they need the broader market to just keep rewarding the entire quantum sector with these astronomical valuation multiples. And you know what? This optimism actually extends way beyond just YouTube commentators. We're seeing consensus estimates from Wall Street analysts projecting significant double-digit upside from current levels. When analysts at major firms put out average targets hovering around almost $18, with some pushing as high as 27, It provides this layer of institutional validation to all the retail hype. It basically tells the bulls, hey, the smart money sees this massive upside too. Okay, but now we've got to pivot hard to the auditor's perspective. It's time for the financial reality check and a true value audit. Check out this staggering metric, 640x. That's their price-to-sales ratio, meaning investors right now are paying literally hundreds of dollars for every single dollar of sales the company actually makes. To put that into perspective, a mature, healthy tech company might trade at, 5 to 10 times sales? Even a hypergrowth software company might trade at 20 times. At over 600 times sales, QVT is priced for absolute perfection. Any tiny misstep, any manufacturing delay, or just a broader market downturn, and that multiple could compress violently. And when we map out their earnings history, it's a roller coaster. We see wild, unpredictable swings driven by one-off events and acquisitions, not a stable, scalable business. Just look at Q2 of 2025, a $36 million loss on just $61,000 of revenue. Ouch. Then jump down to Q1 of 2026. Revenue spiked to over $3.6 million, but they still posted a net loss of $4 million. Guys, this is not the footprint of a mature, stable business. It's the financial profile of a highly volatile, cash-burning startup. The grim, fundamental reality here is that despite the massive percentage growth we talked about, they're operating with deeply negative profit margins. They're burning through cash. Basically, every dollar of sales currently costs them more than a dollar to deliver. Operating expenses, which are heavily driven by R&D and administrative costs, just completely outweigh the money actually coming in the door. Now, they do have a strong cash runway thanks to recent financing, but that runway was built on heavy equity dilution, which means your piece of the pie as a shareholder has been getting smaller and smaller just to keep the lights on. To really ground these sky-high valuations, let's look at the ultimate valuation verdict using Phil Town's famous payback time framework. If you're not familiar, this four-step method is strictly designed to find mature businesses with predictable earnings that will literally pay back your initial investment within 8 years. It's a super conservative, no-nonsense approach to steady growth. It asks one simple question. If you bought the entire business today, how long would it take for the cash that business actually generates to pay you back your purchase price? Well, spoiler alert, QUBT completely fails the basic filters. Because they have negative, wildly swinging earnings and operate like a pre-profit startup, you literally cannot calculate a standard payback time. Why? Because their trailing 12-month earnings are below zero? For a strict fundamental value investor, the analysis literally stops right here. Without predictable cash flows, you aren't investing, you're speculating on a future narrative. In fact, even if we injected incredibly aggressive growth assumptions into the payback time model, like best-case scenario stuff, the theoretical intrinsic value sits between just $1 and $2 a share. Even assuming a perfect world where revenue grows 50 to 70% every single year for the next decade, with excellent profit margins they don't even have yet, the math dictates the current stock price is dramatically overvalued. The gap between today's double-digit share price and the actual intrinsic value based on cash flow is just massive. So, how do we categorize this massive disconnect? $50 hype versus a $2 fundamental audit. Let's look at the ultimate contrast through two totally different investor lenses. Honestly, it purely comes down to your investor profile. On one hand, you have the value investor. The data tells strict fundamental analysts to just walk away. They demand predictable earnings and a margin of safety. But on the other hand, if you're a high-risk, momentum-driven speculator, you probably view QBT as an option like venture bet. You aren't buying current earnings, you're buying a literal lottery ticket on the future of photonic chips, knowing full well you could lose a huge chunk of your investment if they fail to execute. So, as we wrap up this explainer, you really have to look objectively at these two distinct scales of risk and reality. Is QBRT the rare, ground floor opportunity to buy into the foundational hardware of the next technological age? Or is it just a classic case of market exuberance,